Welcome to TMC Connect. We'll get started in just a minute. All right, looks like we are at the top of the hour. Hello, it is 12 o'clock Central, 1 o'clock Eastern. My name is Tony Bramley, and I am with the Business Development, Senior Business Development Director here at the Mortgage Collaborative. We are so glad that you guys are joining us today for TMC Connect. We have a great session for you. One big, beautiful bill act highlights from our partners with Cathedral CPAs and Advisors. We are going to have a great call today. You guys are all on mute, but we do want it to be interactive. So if you've got any questions as they go through the presentation, please feel free to drop those in the chat and we will take those up at the end of the presentation. You will get a follow-up email as well tomorrow with a link to this recording, and Santo and his team are also going to provide the deck that we are reviewing. So thank you all so much for being here, and without further ado, I will turn it over to Santo.
Thank you, Tony. Hi, everyone. Really appreciate everyone being here and make a brief introduction. So I am one of the partners and founders of Cathedral CPAs and Advisors. We are a firm that specializes in mortgage banking, and we have about 120 lenders across the United States. We provide all services to lenders, both assurance, tax, audit, advisory. So we kind of do it all. And with me today, I have two of my senior team. We have Lindsay Reynolds, who is a tax manager in our West Coast office. And we have Polly Singh, who is a tax director in our East Coast office. And I guess we can get started because there is a lot to cover in this one big, beautiful bill act. And we're going to go over some of the highlights, but we're going to try to do as best we can to cover as much as we can in the time allotted. So we'll get busy and start. Okay. All right. All right. So first, we're going to talk about bonus depreciation. So Lindsay, we will start with you. So Lindsay, you can go right ahead, and then I'll ask you questions later.
Okay. Hi, everybody. I'm so excited to be here, and we're thrilled to have you join our session. So basically, we'll start with bonus and Section 179 and the changes that took place under the new bill. Santa, did you want to ask me a question?
Yes,
Or
yeah,
okay,
yes. I just wanted to introduce yourself. Yes. So Lindsay, what is the most significant change to bonus depreciation under OBA?
Okay, so basically, before the bill, we were in 2025 going to hit 40% of bonus depreciation. And in 2026, it was about to drop to 20%. And then after that, it was going to sunset. So we were losing it slowly. Now, under the bill, we are looking to have it permanently restored to 100%, which is amazing. This actually takes place starting in 2025 after January 19th. And yeah, so the 100% rate now applies indefinitely to the eligible property. That would be the most significant.
Yes. So the takeaway is, as Lindsay mentioned, is pretty much you get 100% restored depreciation. It's permanent on certain class of assets. So that's what that is. But what changes were also made to the bill that affected Section 179, which is the other expensing method?
Okay, so basically 179, it had a $1.2 million deduction before 2025, so through 2024. And now under the bill, that increased from 1.2 million all the way to 2.5 million. So the new, and then those limits will obviously be adjusted for inflation as years to come. But the phase out threshold is increased. So you got 2.5 million all the way to 4 million. So if you were to have purchased, for example, if you purchased like a $4.5 million asset, what would happen is the maximum deduction would be reduced to 2 million, because once you exceed the $4 million threshold, it's reduced dollar for dollar. But I do also want to just as a reminder that with Section 179, you have to have income to utilize Section 179, and it does not create NOLs like that of bonus. So there is a hierarchy that kind of takes place here, and it starts with first you need to use Section 179, max it out, then bonus kicks in, and then you would use makers for anything after that. Why would we use makers? Because before 2025, we're still going to have assets that don't get to have the full benefit of the 100% bonus depreciation. So, but you can use bonus and it does create NOLs, but you cannot create NOLs with Section 179. So the hierarchy, one more time, it's Section 179 bonus and then makers. And then in going forward, it's going to be Section 179 and then bonus.
Great, thank you. Now we're going to talk about we're going to cover R&D, and I'm sure a lot of you on this call have heard about it. They made a significant change to Code Section 174 on the R&D and made a significant change there. So, Lindsay, what is the core change to the tax treatment of R&D expenditures under the One Big Beautiful Bill?
Okay, so now the bill has restored the immediate expensing for all of your domestic research, your R&D, research development, experimental, for tax years beginning after 2024. So that would start in January of 2025. Taxpayers can now deduct the R&D costs in the year paid or incurred, and rather than capitalizing them and amortizing them over the 5 years, as was it under the prior law. The requirement to capitalize and amortize over the 15 years, it still holds and remains in place for all the foreign R&E still. So no change there. And again, this begins after 12/31/2024. So anything in 2025 going forward. But we'll get to the next part in a second.
Okay, so what options are available for taxpayers regarding the timing of the deductions for the domestic R&E expenditures?
So we just talked about how after 12/31/2024, this is available. So you can immediately start expensing in 2025. You can elect to capitalize and amortize over the course of 60 months. And there's also another option where you can elect a 10-year amortization. Not everybody wants to take the deduction up front. They like to spread it out to line it up with income over the course of time. So there are options, but the smaller businesses have another option. They can elect to apply the provision retroactively for tax years 2022 through 2024. And this can be done as long as all the amended returns are completed by January 4th of 2026. So, and anybody can elect to accelerate any unamortized domestic R&E from prior periods. So anything before 2025, whatever is left on the credit, you can now accelerate that into the current methods as well, which is a pretty cool benefit.
Great. And also it's important to note on this R&D, because you may say, well, why, how does this apply to us? as mortgage bankers? Well, you have a lot of R&D expenditures with regard to your Encompass enhancements, Encompass software, some other softwares that you may have developed. And that all takes into account as part of calculating this credit. And it is a significant credit, and it's something you may want to speak to your tax preparers about, because they may not be aware. Usually when tax preparers think R&D, who are not familiar with the mortgage industry, the first thing that comes to their mind is maybe pharmaceutical or something like that, where there's R&D expenditures there. But I would say that over 60% of our mortgage bankers take advantage of this credit. And with the new change in the law, it is definitely something you want to look at. Okay, so next we're going to cover the new interest expense limitation, which I'm sure some of you have experienced, where you weren't able to deduct all of your interest expense due to certain limitations. There were changes made to that. So Lindsay, you're up again. How does the One Big Beautiful Act change the Section 163J business interest expense limitation?
Okay, so this one's a really big deal. This is a good one. So EBITDA, what does that stand for? Earnings before interest, taxes, depreciation, amortization, depletion. So under the bill, it was restored to, the EBITDA was restored. So under the prior law, so tax years 2021, after 2021, but before 2025, the limitation on deductible business interest expense was 30% of only earnings before interest and taxes. So what does that mean? It means that depreciation and amortization and depletion were not allowed to be added back to AGI. So what that did is it created that smaller base. And so you're taking 30% of only the earnings before interest and taxes. Now, under the bill, adding back the depreciation, amortization, and depletion amounts, those can be rather large. So you're going to increase your base, and so you're taking the 30% limitation, and it's going to result in greater deductibilities of that business interest expense.
Okay,
Actually,
great.
I
And
wanted to just,
so,
oh, go ahead. Sorry, go ahead.
sorry. So I think you'd want to maybe to illustrate it, walk through a quick example. I know we're kind of time constrained, but let's maybe walk through a quick example.
Okay, so if we were to actually like visualize this, so we have this example that I put together. I kind of kept it simple so that we could follow along easily. But we have business interest income of 20,000. You have business interest expense of 120,000. Your depreciation and amortization are 100. Your other ordinary deductions excluding the interest, depreciation, and amortization are $500,000. Gross income before deductions would be $1 million. So now we need to compute the ATI, the adjusted taxable income. So what we would do is we would take the tentative ATI plus the depreciation and amortization plus the business interest expense. So ATI equals that 280,000. We get that from taking the gross income minus the ordinary deductions, minus the depreciation and amortization, minus the business interest expense. That'll get us the 280. Then we're going to go ahead and plus add back the depreciation and amortization, and then we also add the business interest expense. So that gives us our ATI of $500,000. The next thing we're going to do is calculate the limitation. So the deductible business interest expense is limited to the sum of business interest income plus the 30% of the ATI, which we talked about earlier, increasing that base. So we would take the 30% of the $500,000, and that'll give us 150,000. We're going to add it to the business interest income. So our limitation is at $170,000. So now we're going to determine the deductible amount of the disallowed interest. So since we go back to the business interest expense, since that $120,000 is less than $170,000 of our limitation, we can take the whole thing. So there will be no carry forward. So this will be handed out to you guys after our presentation, but this is just an example so that you can see and visualize how it affects.
Great. Thanks. Thanks a lot, Lindsay. So now I know that most of you who are pass-through entities are familiar with QBI. You've probably heard it, Section 199A, qualified business income. So we are going to now, Lindsay, we're going to also now talk about QBI. And this is something most of you probably know, but we're going to talk about the key changes under the new bill for QBI. So Lindsay, why don't you go ahead and talk about some of the key changes under the new bill for qualified business income deduction?
Okay, so basically before the bill, the 20% deduction for qualified business income was set to expire after 2025. The bill removed the expiration date and now it's permanent beginning after December 31st of this year. So owners, business owners can continue to deduct the 20% of their QBI. But now there's higher income thresholds. So what does that mean? The QBI is subject to certain limitations based on your taxable income. Under the old law, these limitations began to phase in once your taxable income exceeded a threshold amount, with a full phase in over the next $50,000, $100,000 for joint filers. But with the bill increases these phase-in ranges to 70,000 for single filers, 150,000 for joint filers. So this means that more business owners can take the full deduction before the limitations start to apply, and the phase out will become more gradual.
So are there any new deductions under the bill for QBI?
Yeah, so the bill actually introduces a new rule. If you actively participate in your business and have at least $1,000 in qualified business income from all your active businesses, you are guaranteed a minimum QBI deduction. It's for $400, even if your calculated deduction would otherwise have been less. Both the 1,000 income threshold and the 400 deduction will be adjusted, obviously, for inflation next year.
Great. All right. Thank you, Lindsay. Thanks for all of that. And we're gonna turn it over to Polly Singh. And Polly, why don't you talk about the pass-through entity and the PTET regime, which is something that most everyone should take advantage. If you have a pass-through entity, means an S corp or a partnership, it's definitely something you want to take advantage of as a workaround. So Polly, I'll give you the floor.
Sure. Thank you so much, Santo, for the opportunity. And Tony, thank you. Thank you all to join us on this session and hear us about the One Beautiful Bill, which is definitely a beautiful bill because it gave us so many opportunities of deducting expenses and like turnaround for tax deductions. So one of the big thing that came out with the OBB is the PTET taxes, which relates to pass-through entity taxes. And this was brought in back in the TCJA rules when the deduction for salt at the individual level was limited to a 10,000 grand, which was a big hit. So OBA came around and increased that deduction to 40,000, which gave an opportunity to the individuals to go and deduct that 40 grand. The turnaround for that one was the PTET tax, which can be elected at the pass-through levels, as the word says, pass-through entity tax. So any entity, which would be a S corporation, a pass-through entity, can elect into the states to have the opportunity to take the deduction at the entity level. The tax is deducted at the entity level, and the credit gets flowed to the personal return, and the individuals can take the credit on their personal returns. Thank you.
Great. So Polly, and I think we mentioned it already, which entities are eligible to elect the PTE tax?
So the entities are going to be the partnership returns, the S corporation returns. We do not get the opportunity for the C corporations, but because when TCJ came, they had already reduced their taxes from the 40% down to 21%. So there is no tax deduction and it doesn't flow to individual returns. So it's basically from the pass through. We cannot do it neither on single member LLCs. So it's pass-through entities.
Great. And how is the election made? Tell the audience how the PTE tax election is made.
So originally when the election and this regime came in, the elections were required to be made outside of the forums. But recently with the new updates and the new state rules, most of the elections can be made on timely filed returns. But there are three states that I can definitely say on top is New York. There is a requirement to do the election in the running year on March 15th. California definitely is June 15th if it's the first year. You need to make the $1,000 payments and get elected in. And New Jersey, you can make the election till you file the your extension for the current year tax filing. So, but there is a check the box on most of the state returns is a check the box on the timely filed return, extended returns. We can get elected into the PTE elections.
Great. And one of the takeaways on this PTE is that it's really you get the best of both worlds. You get to deduct the PTE on your federal tax return, which reduces your federal taxable income, and then be able to take that, as Polly had said, be able to take that tax, that payment, and apply it towards your personal tax payments. So state tax payments. So it is a win-win, and it's something that you should really, or everyone should look into. So now we're going to discuss the excess business loss deduction, code section 461A. I know there's been a lot going on with this over the past, and NOLs and and how it works. So it's a little complicated. We're going to shrink it to a couple of minutes. But Polly, tell the audience how is an excess business loss calculated?
So any non-passive income on your personal returns, that would be from S corporations, partnership returns, business from the Schedule Cs, everything can be combined together. And you have a total business loss that could be offsetted against your business income. So there is a threshold for single filers and merit filers. So a merit filing joint return can go all the way until $626,000 and take that deduction and reduce their taxable income by that much.
And how does the excess business loss limit apply to all types of businesses?
So the losses from the sole proprietorship partnerships flow through entities that they flow to their personal returns, they apply. There is a big change from the prior year in the current year is any excess business losses, they were converting into NOLs. Going forward, they are not going to be converted into NOLs, and they will still stay as excess business losses, and they can be deducted against your earnings.
And how does it interact with the NOLs and the carry forwards?
So the NOLs, we cannot combine the NOLs with the EBLs. NOLs are calculated separately. NOLs go against your 80% limitation, which is your adjusted income. So you can go all the way only until 80%. So we have to take the EBL first before taking the NOL deductions from prior years.
Right. And basically this is something that requires a lot of planning around it. So speak to your CPAs and your tax preparers regarding these carryovers because you can plan around them to try to maximize benefits there.
Yeah, yeah,
And
yeah.
yeah, Polly, sorry.
Yeah, like the planning is definitely much required because you don't want to keep increasing your losses. If you have carryover NOLs, you want to consume them and not increase your current year losses. So expensing and like working around your expensing and like going aggressive on depreciation, those are the areas that you want to definitely target and maybe target, deferring your income, the revenue. So it's a lot of planning and it's the time to do the planning as we are around the corner of the year end.
And Polly, would you want to go through quickly this example for the audience? We will be distributing these slides to everyone on this call, but Polly, you may want to just run through this.
Yeah, so this is regarding the EBL. So over here, it's a clear example over here. If you would see that if we have a partnership, it has an income of for 200 grand on one of the entities and the other entity has a loss of $1 million. We have a W-2 wage of 150. We would combine the passive, non-passive income from the two partnerships and we come to a net loss of 800 grand. So we have the 800 grand, which can offset our against the limitation, the business excess limitation. So we can forego the 626 and we have 174 that what we are left with, which is a disallowed loss, which would be carried forward, and it would not be carried forward as a NOL. It will be carried as excess business loss going forward from the current year. So, and if we have a carryover loss over here, I'm saying is that they have a EBL from prior year of 350,000 that will carry forward because they would not have income to offset that.
Great. And one of the takeaways here is just to be to know that if you did have a business loss, that you're only able, if married filing a joint return, you're only able to offset 626,000 of other non-related business income. Where before this, if you did have a loss, that loss would be able to wipe out most, if not all of your non-business income. So this is something significant, and really you should look at it with your CPA to see how you can plan around it. So the last topic we're going to speak of is the qualified opportunity zone. There's been a significant change here, which is something that Polly is going to talk to us about now. And so Polly, talk to everyone about how the qualified opportunity zone tax deferral works for gains that are realized, capital gains that are realized in 2025, and the significant difference that was made as a result of the One Big Beautiful Act.
Yeah, so the opportunity zone, this came also at the time pre-COVID, and there was a lot of investments and there's a lot of change over here. This became a permanent. It's not going to offset in 2026. And there is going to be a 10% exclusion on the basis, setup basis for 5 years. And there is a big thing that came in if you are investing into a rural incentive areas, you can exclude up to 30% of your investment gains. So that is very big. But it is a lot of intensive filing requirements and everything over there. And there are filing forms required. I can give you an example of an investment. If you have gains in 2025, you have a 180-day period window that you need to reinvest only the gain portion of your gains into opportunity zone to defer the gains. You can defer the gains only up till the time you sell, or which is 12/31/2026, because the new opportunity zone comes in effect with the new rules if you are having sales after 2026. So there are too many rules and too many criteria that you have to look into this one. So if you are having a sales in 2025, you invest it, you defer the gains for a year or 2-year window time. You pick up the gain on your filing of your 2026 return. You pay the 20% tax on the long-term gain. You can defer all the gains you have earned in that QOF, and all that would be all tax exempt, depending upon the period of the sale that you would do. So basically, it is pretty intense. It requires a lot of advisory scenarios over here, like especially the time when you are selling and investing into an opportunity zone. So like Santo is reflecting this slide over here, it clearly shows if we have $1,000 proceeds, we have a $2,000 basis, the capital gains over here is 800 grand. And if we invest that into an opportunity zone, I can forego we can defer the gains. We get a basis in there, and we can keep growing that investment for another 10 years, and we can defer the gains on them.
Great. So as you see, there's a lot here, and it could be great opportunity if you're selling MSRs and you have capital gains. There could be a possibility with this qualified opportunity zone to defer the gain as well as possibly even eliminate the gain. So I know there was a lot to cover here, and we just touched on most of the key items that affect the bankers. Here we have that's all, folks, and we have our email addresses here where we welcome questions. If anyone has any questions, we have our phone number here. Everyone will get a copy of this presentation, and if you have any questions at all, please feel free to reach out to anyone on the team.
Thank y'all so very much. The information, the detail, it was fantastic. And the examples that you share, I'm sure that those are going to be incredibly helpful for all the folks on the line, as well as anyone who registered for this. So thank you again for your time. It was a pleasure. Really, really appreciate you. And Cathedral CPAs and Advisors are just such a great partner with the Mortgage Collaborative. And we thank you guys very much for sharing your expertise with us today.
Thank you,
And
Tony.
thank you very much for allowing us to do this presentation. Thank you.
Happy to. Thank you so much. Thank you, everyone that has joined. We appreciate it. Come back to TMC Connect anytime, and have a great day. Thank y'all.
Very good. Thank you.
Thank you.
Bye.
Bye.
Bye.